Audit assertions answer the question, what is the auditor trying to verify or confirm when they're doing audit work? Before we get started, there's two broad statements that I want to make. And the first is that audit work on the balance sheet can provide evidence that will also apply to the income statement. So for example, account receivable test work will relate to revenue and will also relate to bad debt expense. Both are income statement accounts. So some of this test work you're doing in the balance sheet is going to relate and help you confirm balances on the income statement side. Another is that we are most concerned about assets being overstated, and we're most concerned about liabilities being understated. So what I'm going to go over is the transaction level assertions. So the first one is existence or occurrence. Best example here is this is why we perform a physical inventory count, comparing the actual items in inventory to our inventory listing, because that proves that they actually exist because we counted them. It's existence or occurrence. Next one is completeness. Search for recorded liabilities is performed to make sure that we've captured all accounts payable liabilities within the period. That's why we're going to look at checks written after year end to see if they're writing checks for liabilities that existed before year end, and if they did exist, did apply to before year end, did they record them? Because again, liability account, accounts payable, we want to make sure it's not understated. We want to make sure we're collecting everything, all the accounts payable balances. Third is accuracy. This is why we recalculate interest expense by looking at loan documents from a bank and recalculating interest expense on a loan. That's accuracy. Cutoff. A good example here is revenue recognition. Do those sales right before the end of the year, were those completed based on how we recognize inventory in the past? If we have to ship items to recognize revenue, did items posted right at the end of the year get shipped before the end of the year? Because if they didn't, they might not apply to revenue. We don't want revenue to be overstated, so that's why we look at cutoff when it comes to revenue recognition. And finally, classification. The current portion of long-term debt, the long-term debt that's due within 12 months, that is actually a current liability. So we want to make sure that the current portion of long-term debt gets recorded as a current liability. So those are some of the audit assertions auditors use when they go through the auditing process.